It looks like a simple choice: old coins or modern bars. But history shows that the form of silver you choose often decides who survives a monetary reset and who doesn't. One option favors liquidity when trust disappears. The other favors efficiency when systems still function. Both are silver, yet they behave very differently when inflation accelerates, when currencies weaken, when markets stop acting rational. Most people never study this distinction, and by the time they realize it matters, the window to act is already closed, because the real risk isn't owning silver. It's owning the wrong kind of silver at the wrong moment, and that moment may be closer than most are prepared for. Welcome to Boring Currency Index. If you're someone who's been through a few economic cycles already, someone who understands that real wealth decisions aren't rushed, then consider subscribing, not for excitement, but for clarity when it matters most. And before we begin, tell us in the comments, where are you watching from today? For decades, silver has been treated as a commodity, something that rises and falls with market demand. But serious capital allocators do not see silver that way. They see it as a monetary instrument, one that behaves differently depending on how it is owned. This distinction becomes critical during periods of financial stress, when systems weaken and trust erodes. At first glance, a question appears simple. Should one buy 90% silver coins or modern silver bullion? Both contain silver, both track the price of the same metal. Yet history shows that the form of ownership often matters more than the metal itself. When monetary systems function smoothly, efficiency dominates decision-making. Investors prefer assets that are easy to price, easy to store, and easy to scale. In such conditions, differences between silver forms appear minor. But during inflationary periods, banking disruptions, or currency instability, the rules change. Liquidity, trust, and flexibility replace efficiency as the primary concerns. This is where many investors make a mistake. They assume that silver behaves the same in all forms, under all conditions. It does not. The market treats silver differently based on recognition, divisibility, and historical trust. These factors do not appear on a price chart, yet they often determine whether an asset can be exchanged when it is most needed. 90% silver coins carry a long monetary history. They circulated as money, they were used in daily transactions. Their value was understood without explanation. Modern silver bullion, by contrast, was designed for standardized investment and institutional trade. It prioritizes purity and uniformity over historical familiarity. Neither approach is inherently superior. The issue is context. Strategic investors do not ask which form is better in general. They ask which form performs better under specific economic conditions. Business leaders understand that resilience matters more than convenience when systems are under pressure. The choice between 90% silver coins and silver bullion is therefore not a collector S debate or a hobbyist S preference. It is a question of risk management. It reflects how an individual expects markets to behave, how they assess future liquidity, and how they prepare for uncertainty. History offers a consistent lesson. When trust in financial structures declines, assets with broad recognition and transactional flexibility tend to outperform those optimized only for efficiency. This does not eliminate the role of bullion, but it reframes its purpose. Understanding this distinction early allows decision-makers to position themselves before stress appears. Waiting until conditions force the issue often removes choice entirely. In monetary strategy, timing is rarely generous and form is never irrelevant. Long before financial products, digital balances, and paper promises dominated commerce, money needed one essential quality: immediate trust. 90% silver coins were born in that environment. They were not designed for investors. They were designed for citizens, merchants, and everyday trade. This origin gives them characteristics that modern financial instruments cannot easily replicate. These coins, dimes, quarters, and half dollars minted before 1965 were used hand-to-hand for generations. Their value did not depend on branding, marketing, or certification. People recognized them instantly. This matters because in periods of uncertainty, recognition often becomes more important than technical specifications. From a strategic perspective, 90% silver coins offer a form of decentralization. They exist outside complex systems. They do not rely on electronic verification, institutional approval, or large transaction sizes. Each coin represents a small unit of value, which gives the holder flexibility. They can exchange a little or a lot without converting or dividing a larger asset. Liquidity is another key factor. Coin shops, private buyers, and bullion dealers consistently accept 90% silver. The spread between buying and selling prices often remains narrower than expected, even during volatile periods. This stability is not accidental. It is driven by familiarity and long-standing demand across different market conditions. However, these advantages come with trade-offs. 90% silver is not pure. It contains copper, which increases volume and reduces storage efficiency. For large holders, space becomes a real cost. In addition, pricing is not always intuitive. Value is measured in face value, wear, and silver content rather than simple ounces. This adds complexity, especially for those accustomed to standardized products. There is also the issue of condition. While most 90% silver trades for its metal content, certain coins carry additional premiums due to rarity or quality. This can create pricing variation that requires experience to navigate. For strategic buyers, this is neither a benefit nor a flaw. It is a factor to manage. The key point is this: 90% silver coins function well in environments where trust is personal and transactions are fragmented. They favor adaptability over efficiency. They are not optimized for maximum density of wealth, but for usability under strain. For decision makers who value optionality, these coins represent more than silver content. They represent a form of monetary memory, one that has already proven its role when systems changed before. Silver bullion did not emerge from everyday commerce. It emerged from the needs of organized markets. Its purpose is not history or familiarity, but precision. Each bar and coin is engineered to solve specific problems faced by modern investors: standardization, efficiency, and scalability. In bullion form, silver is reduced to its most measurable state. Weight is exact. Purity is explicit. Value is calculated instantly. This clarity aligns well with structured financial systems where speed and uniformity matter. Institutions, funds, and large private buyers favor bullion because it integrates smoothly into existing market frameworks. Storage efficiency is one of bullion's strongest advantages. 10 ounces of silver occupy the same physical footprint, whether held in one bar or multiple rounds. For those managing larger allocations, this efficiency reduces logistical friction. Transport, vaulting, and inventory tracking become simpler and more predictable. Bullion also benefits from global recognition, particularly government-minted coins. Products such as American Silver Eagles and Canadian Maple Leafs are accepted worldwide. Their backing by sovereign mints reduces doubts about authenticity and weight, which improves resale confidence in functioning markets. Yet bullion's strengths reveal their limits under stress. Premiums often expand rapidly during periods of high demand. When investors rush for exposure, standardized products attract competition. Buyers may pay significantly above spot prices and later discover that premiums are not fully recoverable when selling. Divisibility presents another constraint. Large bars concentrate value efficiently, but they restrict flexibility. Selling a portion of holdings may require liquidating an entire unit. This can force poor timing decisions when markets are volatile. There's also the issue of trust asymmetry. Bullion relies on verification, assays, mint marks, and packaging matter. As demand increases, so does counterfeit risk. This does not eliminate bullion's utility, but it introduces an additional layer of caution that must be managed. From a strategic standpoint, silver bullion performs best when systems remain intact. It assumes the presence of dealers, pricing mechanisms, and standardized exchange channels. It excels in environments where markets are stressed but still functional. For disciplined capital managers, bullion represents concentrated exposure with minimal friction. It is not designed to replace all forms of silver ownership. It is designed to operate efficiently within structured conditions that cannot always be assumed, but when present, reward precision. When comparing 90% silver coins to modern bullion, the difference is not merely historical or aesthetic. It is fundamentally strategic. Each form embodies a distinct approach to risk, liquidity, and resilience. Understanding these differences is critical for business leaders, entrepreneurs, and capital allocators who seek to preserve wealth under uncertainty. 90% silver coins excel in environments where trust in institutions is low. They offer fractional ownership, high recognizability, and a proven track record of circulating value. Coins can be used in small increments or large amounts, making them ideal for transactional flexibility during periods of market stress. However, their lower purity, storage demands, and complex pricing introduce trade-offs that cannot be ignored. Bullion, by contrast, thrives in structured, efficient markets. Standardized bars and government-minted coins deliver precise weight, purity, and storage efficiency. Large allocations can be handled with minimal space and logistical complexity. Global recognition of sovereign-minted bullion enhances liquidity across borders, and institutional buyers are comfortable transacting at scale. Yet, bullion can suffer when markets become disjointed or when premiums spike. Its divisibility limitations and dependence on verification can hinder quick exchanges in times of crisis. Strategic allocation requires careful scenario analysis. If inflation accelerates, trust in paper currencies erodes, and liquidity becomes constrained, coins may outperform bullion because they are easier to trade, even in fragmented or informal markets. Conversely, in periods of systemic stability with high capital mobility, bullion provides more efficient storage, transparency, and scalability. Entrepreneurs and investors often make the mistake of treating silver as a single asset class without considering form-specific risks. Concentrating entirely in one type can create hidden exposures. Over-reliance on coins may result in inefficient storage or complex valuation, while over-reliance on bullion may reduce flexibility in moments of stress. The most resilient portfolios recognize the complementary roles of each form. Ultimately, the decision is not about which silver is better. It is about which form aligns with one's strategic objectives, risk tolerance, and anticipated market conditions. Coins offer adaptability, historical trust, and transactional optionality. Bullion provides efficiency, standardization, and institutional compatibility. Together, they form a balanced approach that addresses both routine and extreme scenarios. For serious decision makers, the question becomes clear. Owning silver is only part of the strategy. Choosing the right form at the right time is what defines resilience. Timing, allocation, and context dictate outcomes far more than spot prices or individual preferences. In a world of uncertainty, form matters as much as metal, and those who understand this distinction position themselves to act decisively when markets shift.